What stocks should I invest in? What stocks should I invest in? Today I'm going to show you exactly what stocks or what group of stocks you should invest in. But before I tell you that, let me ask you a question. If you were throwing a barbecue, let's say you could throw a barbecue any day of the week, no one worked a job, no one did anything else except they wanted to attend your barbecue. That's it. If you could throw a barbecue any day of the week, what day would you throw a barbecue? Now you may ask, okay, well, what other information would I need to know, or what other information would I have to consider before I answer that question? A main element you may consider before you throw a barbecue is the weather. If it's going to rain Monday, Tuesday, Wednesday, and Thursday, but Friday it's going to be 90 degrees with sunny, all sun, you may want to consider throwing a barbecue on Friday. Likewise, in the stock market, if you want to know, before you know what stocks you should invest in, you need to know, is it a good time to invest in stocks? So you need to know if it's a good time to invest in stocks. So let's look at the Dow Jones. This is an overall average of stocks past 100 years. Let's see, let me go to all years just to get an idea. Here, from 1921 to here, it's a great time to invest in stocks. Keep in mind this is inflation adjusted, but still the results are similar. 1965, if you were actually buying stocks here. 1948, this is when Warren Buffett made a lot of his money. Great time to buy. Look at this, great time to sell. Okay, now here, 1965 to here, horrible time. Horrible time to buy, horrible time to sell. On the contrary, here, 1980, remember this number, we're going to reference it a lot. 1980, actually 1965 to 1980, we'll reference this a lot. 1980 to 1999, congratulations. One of the best times to buy ever, if you bought stocks here to here. Now, 1999, 2000, remember that time as well. To here, the Dow was, this is inflation adjusted, Dow was 16,000, let's say, went down to, where'd it go? 8,000. So you lost 50% of your money, took 9 years. Horrible time to invest. Here, 2009, early 2009 to here, 2018, give or take. It's a great time to invest here. Now let's dig a little deeper. If I look at here, you can start to see that maybe going down. We don't know for sure, but this is just one chart. So this chart is just a Dow Jones, the history of the index, and it just shows you, how various times have performed. Now, this is a key chart. This is kind of similar to let's say a thermometer or a whatever tool tells the humidity. No, it's not a humidifier. That gets rid of humidity. But this is like the humidity index, where it tells you if it's going to rain or not. So if it's over 30, over 25, the higher it goes, more likely it's going to rain. And rain is just, metaphor for something bad is going to happen. So let's look. 1929 is over 25, or 25 and older. 1929, you got the Great Depression, right? And we saw on, what chart was it? This chart, it corresponds. This chart, is it this? No, it's not this chart. I got a lot of charts up. Is it this chart? Yeah, here it is. So here, you lost like 90% of your money. Corresponds to that one. So this is the second one. Okay, now here we have another period, 1965. Horrible time to buy. Let's look at the corresponding period here. This looks horrible to me. You lost 50% of your money, and this is over. Let me make sure. Well, actually, more than 50% inflation adjusted. This is 1965. So you waited 15 years to lose over, maybe 70% of your money. Horrible. So let's see here. Oh man, look how high this one is. 1999, over 25. Yep, it passes the test. Let's see what happened from 1999 to 2008. Let's see if you lost any money, even though we should know the answer. 1998, well, 98, 99, whatever. 17 to 8,000. I know that's about more than half. So it's a horrible time. So basically, this gauge here is one of the tools you use. One of the many tools in your tool belt that I'll go over tells you that it's a horrible time to buy stocks. Now we look at it now. This may not be, we look at it now. This may not be something that you want to hear, but buying regular stocks now is a horrible investment. You know, it's a horrible thing to invest in regular retail stocks. You still have stocks to invest in, but we'll cover those. But retail stocks, your Googles, your Nikes, your Coca-Colas are horrible stocks to invest in. Your Home Depots, you know, we'll look at some of those as well. So if you bought here, this was actually, yeah, I can't zoom in on this chart, but this high point here was actually a few months ago, and since then the Dow or S&P, whatever one, you know, pretty similar in terms of their decreases and increases, went down about 17%. So if you can get out here, that is an optimum choice. So let's look at stocks, regular retail stocks from 1999 to 2008, because remember, if you invest here, even 27 right now, you're setting yourself up for horrible returns. But I'm going to show you the class that actually performs the best under these conditions in a few minutes. But here, horrible. So let's look at some regular retail stocks from 1999, 2008. And actually, let me go back to this one. I don't want to go here. I don't want to go here either. I want to go here. And also, we'll try to look at some stocks from 1965 to 1980, because that should have been equally as horrible time to invest. We can't really go back here on a chart because it's not much data, you know, that has individual stocks, but you still can find some if you look at some old books. But I don't want to go here. Excuse me. I want to go here. So let's see. Let's look at Nike. Nike from 1999. Let's look at 99. Here we are. So if you invested in Nike, it was $3.50 in 99. Actually, well, let's just call it $5. It was $5 in 2099. It's $7 here, so we'll just average it out about $5. 2008, it was 10. So you got to double, you know, and you may have purchased all the way here, you know. So you doubled your money, and you probably averaged at a higher price, but I'll give you the benefit of the doubt, you doubled your money. That's one. Let's look at Microsoft. Actually, yeah, Microsoft, you bought it 99 for $58. You sold it 2008. It's regular retail stock. $17. Horrible investment. Even if you purchased the whole way. Let's see if you purchased the whole way from 99 to 2008. Look, you're buying over $17. Look at that. You're buying the whole way down. You're buying over $17. Now, it was a good time to buy after, as you saw in the other chart, the other index rather. You bought here 16, now 114. So, you know, you got almost 10 times, maybe 8 times your money. Let's look at Coca-Cola. Coca-Cola is one of the rare stocks that does go back to 1965. So let's look at that 1965 to 1980 period, where it was a horrible time to buy stocks. 1965. So you bought, what's this? Coca-Cola? Yeah, Coca-Cola. So you bought Coca-Cola for 65. Where are you? For about 40 cents. Let's call it. Yeah, we can say 67. Let's say 60 cents. 64 cents, 40. Let's say average it out 50 cents. So we'll go to 80. Where are you? 80. Look at that. It's 60, 79, 69, 70 cents. So your return was about a 20% return. And you waited 15 years for that return. Let's look at one more. You know, we can do this for days, but I just want to give you an idea. Pepsi doesn't go back that far, but let's look at 72, $1, 61 doesn't go back to 65. Let's see. Look at that. You lost money. You waited 6 years. Oh, actually even more, 8 years. So 160 to 181. It's basically 0%, let's call it. So you waited 8 years and you didn't make any money. And let's look at 99 to 2008. 1999 or 2099, whatever. So it's 40 here. Let's look at 2008. 48. You got 20% return in 8 years. However, let me show you gold. This is one of the classes, it's a commodity class that performs in these situations. So if you want to buy stocks, you want to buy commodity focused stocks. So let's look at gold here. Here we are. So we're going to look at gold from 1965 to 1980 because remember, Coke, Pepsi went virtually nowhere, right? And overall stocks went down 60%. So let's see what the gold do. Oh, look at this. Gold 60. Let me go to 65. $35. Gold commodities, whatever. 1980. Look at this. 700. Let's call that 700. Actually, it hit 800, but the time period was so short that it's not reflective on the chart. But you got 35 to 700. So you got about 20 times your money in a case where Coca-Cola, Pepsi, you didn't get anything. All right, and remember that other time period we discussed, 1999 to 2008, where I think you got 20% on Pepsi. You got you didn't get great returns during that period. I forget, but some were like down, even, whatever. You can rewind the video if you want to see the exact. But let's see here, gold about 250. Let's see, 2008. Look at that. So 250. We can go a little bit more. 2009. So let's say, because it's early 2009 to 99 to early 2009, late 2008. So 250 to 1,000. And if you take it to 2011, 250 to 1,700. This is the asset class you want to be in commodities. So you may say, I don't believe that. I'll show you some more commodities. Actually, let me backtrack a little. I actually want to show you this. This is the Dow to gold ratio. The Dow is a representation of all the money, all the liquidity in the economy. It's just representative of that. Gold is a representation of real money. However, there's a lag in between the two. It should always be a constant ratio of about 15, maybe 12, 15, 16, around there. It should be a constant ratio. However, it swings like a pendulum. It overshoots, undershoots. Then it overshoots, undershoots, overshoots, undershoots, overshoots. So it's set to undershoot soon. So just know that this is like a pendulum. It's kind of like temperature in the winter and in the summer. So, if you live, like, let's say in Northeast US or whatever country you're in, state you're in, in the winter, you may have extreme temperatures of 10 degrees Fahrenheit. In the summer, you're going to have extreme temperatures, maybe 110. It's not a consistent temperature the whole year round. It swings, and this is no different. This is a swing or cyclical, and it has cyclicality as well. So let's see here. So when this is high, basically it's saying you need to buy commodities. Buy commodities, buy commodities. Right now, buy commodities. The number's usually about 18. When it's over 18, buy commodities. So let's look at commodities. So we're going to look at commodities from a period of 99 to 2008, 2011. We can use either one of those numbers, because you can see the bottom is around here and it's around here. So this is like when the base formed here. So you want to buy here, sell at the bottom, and sell the further down, but you got to unload some here. So let's look at some commodity companies. This is a Cleveland Cliffs. It's a steel manufacturer. I think they make steel in the U.S. So we'll look at 99 or early 2000, whatever. It's $2. You see here, $2. You got dividends the whole way. You sold 2008, $2. Let's call this $100. It's 50 times your money, and you could have bought it the whole way up, even if you held it. And a lot of commodities crash, a lot of things crash, but commodities, the way that they're priced and, the way they're analyzed and used, they bounce at the snap of a finger. They come right back. Usually bounced right back. So you could even purchase hair, still. And it went right back to $90, right back to $100. So you bought all the way over here and you got dividends the whole way. This is a commodity. This is similar to the situation we're in now, where you want to be more focused towards commodities. And as you can see now, it's been a stock buying period. They usually go in reverse because it's like attention. Let's say you got 4 kids. No, let's say you got 3 kids. Let's say 4. It's too many. Let's say you got 3 kids, and you have one that's 8 years old, one that's 2 older ones, and 1 younger one. And your attention that you can give these kids is only so much. You're not operating with an unlimited amount of attention given to kids. So you may give 2 out of the 3 more attention than you give the last one. So this is the situation where we've been in, where investors have been giving more attention, as they should have been, as they should have rather, to retail stocks, to the Amazons, to the Netflix, to the Apples. And these commodity stocks have been unloved. And as a result of being unloved, these stocks, they've had a mild investment in terms of new exploration. So they haven't been uncovering many mines and many oil fields and many new things, because they haven't had the investment vehicles to do so. So this is just one. Let's look at another. Yeah, I looked at the gold already. I forgot. But this is a gold exploration company, 99. Let's see where it was. What's that? $2. Man, these commodity stocks love $2. It's $2. It went from $2 all the way 2008. What was it? 40. You had 45. So you got 22 times your money there. Had a crash. Could have bought more. 2000. Clicked the wrong thing. 2011. 55. Look at that. You got 25 times your money in a period where Pepsi, Nike, Microsoft, these stocks got, I think at the most it was 20% or double. So you got 20. What would you rather have? 22 times your money or double your money? You decide. So that's one. Let's look at another commodity stock. Man, they really do love $2. This is another one. This is, I think, is a Brazilian company. They do some mine, maybe iron ore, gold, everything. I don't know. Yeah, so many stocks. I forget the particulars, but I know I researched this one. But 2000, $2. Look at this, all the way to $44. You got 22 times your money. There's a crash, went back up. So you could have sold here. You could have even sold at any of these points. But 2011, 30. So you got 15 times your money. Let's look at the dividends. Remember, you invested $2. So this is a dividend. I don't know how frequently they were or how often they were doing it, but you invested $2. Let's just count a few dividends. It's 20 cents, 20, 40, 60 cents. You're getting your money back just in the dividends alone. Look at these dividends, 60-cent dividend right here, 57 cents. So let's look at, we'll look at like two more maybe, just to get an idea. This one, and I'll just go quick now. $3. 2011, $50, right? This is a oil exploration. 99, did I say, right? We're at $24. Look at this. 2008, $110. Even if you didn't sell it here, you held. 2011. Still about 3 times, and this is the worst case we've seen. The worst case is better than the best case for retail stocks, for your Nikes, for your Coca-Cola, for your Pepsis. And the last thing I'll show is this. This shows the best in asset class. Let me just go back here real quick. So remember, when it's this high, when the ratio, I'm kind of giving a summary of everything now. When the ratio is this high, you don't want to be in retail stocks. You want to be in commodity-focused stocks. I mean, you can even look at this like a balloon, right? If you know a balloon, let's say you're a clown, no offense, but let's say you're a clown and you blow balloons for a living. You know when a balloon is at its maximum blowing level or its maximum expansion to where it's soon to pop. Okay, so let's call 25 this maximum expansion, where if you blow the balloon down here, it's fine. But if you blow it up here, it's soon to pop. It's like stand back. I blew 1,000 balloons and I know that it's soon to pop. So this is where it was. It popped. This is where it was. It popped. So the retail stocks, because regular people, your average person, has less. Actually, when the stock market decreases, their 401k decrease, they may get layoff from their job, because jobs do layoffs, 401ks decrease. As a result of that, real estate prices get impacted because people don't have the 401ks to buy houses. As a result of those things, let's say you're in the market for a car, you may buy a used car, maybe more likely to buy a used car, or if you need, you may be more likely to get an old car repaired than to buy a new car, with the wealth effect and multiplier effects and many other effects. So the balloon has popped right here. And let's look at this 90. Remember I said the 90 was Dow Gold. Yep. And this is the Dow Gold ratio. This is just a ratio for the Dow Jones to the price 1 ounce of gold. And this was the key time to buy stocks or commodities rather. Sorry about that. From 99 to 2008, 2011. So let's look at this. This shows the best in asset class. And when does this go back to? Oh, this actually goes back into the 80. Remember I said look at the 80 period. So we'll look at this real quick. It doesn't have many years, but you see gold went up 23%, 35. These are annual returns on gold, 133% because it was the best in class. That was the time to buy commodities, gold, precious metals back then. And remember, it started at 99. So let's see where gold, in commodities stack up. So these were stocks. This is risky right here. I mean, you could have sold stocks here. Selling the here is like trying to pinpoint the actual top, or they call it, trying to, I guess the opposite would be to try to catch a falling knife, which is almost impossible to do. And your risk, you could buy it here, but you risk these negative 15% returns, which kind of kill. Then you risk the negative 22. It's like you don't know when to get out. But let's look at gold here, 1%, negative 6, 1. And I know you're like, wow, these aren't great returns, but you see commodities up here, 11%. Now 2002, gold 24, commodities 24, gold 21. And the non-U.S. stocks actually did okay, but you can't really tell. But here you have non-U.S. stocks doing 15. But you just, to avoid that problem, trust me, you want to avoid it. To avoid that problem, you just want to do the commodities, because you'll see 23, 21, 5. Look at all these positive years: 17, 24, 32, 3, 27, 27. And in the last year was the gold at 11%. So it's another commodity buying cycle. I mean, you should see the evidence. A lot of people, they think that me saying, they think by saying, hey, I have Facebook, I have Tesla, I have, what's another trendy? Netflix, Amazon. These stocks sound sexy to the average person. So it's like, hey, what's more attractive to say, I have oil exploration companies, or to say I have Tesla? People will buy Tesla just so they can tell their friends, and it sounds more appealing for them to say they have Tesla. But trust me, the real win and the real sexiness is when you take 10,000 and you get 22 times your money, or if you take 100,000, 1,000, you get 22,000. Rather than taking that 1,000 in Tesla and saying, yeah, I have Tesla, and you turn that 1,000 into 500. Would you rather do? Turn 1,500 or 1,000 into 22,000, or 10,000 into 220, or 10,000 into 5,000? And similar, you go up to 100,000, a million, whatever. So those are the stocks, or the class of stocks that you want to invest in for this upcoming commodities boom that we're going to have. Thanks for watching. To subscribe for more financial content, please click the circular button where the red arrow is located, and also watch one of the top 2 videos up top.